Okay, so now I want to dive in and talk about endowments. And this section, we're going to cover both endowments and foundations. And remember, we talked about as you prepare for the institutional section, how can you score better? What do you absolutely need to know? So defined benefit plans, no excuses, you have to know. Well, foundations and endowments, no excuses. You have to know these. You're going to work a ton of problems, and there are a lot of nuances. I'm going to do my best to bring out these patterns that you'll see today. But again, we can't prepare you for everything. You're going to have to review the material. And this is where I would be using Kaplan material and the CFA Institute source material and problems. I would really be working as hard as I can to practice endowment and foundations and defined benefit plans. Now, sovereign wealth funds, a newer topic. So, it's kind of a wild card. Don't know how much it's going to be impacted. My guess is probably not very much. I'm still more worried about these. And then the last part is we're going to get into banks and insurance companies. And again, not heavily tested. So defined benefit plans, foundations, and endowments, absolutely no excuses. Sovereign wealth funds, we talked about understand the investment objectives, understand the asset allocation, understand the definitions that were put forth by the International Monetary Fund classifications. That's about as deep as I'd go with sovereign wealth. And then bank and insurance companies, our Kaplan material and our slides are as deep as I would go. But again, I want you to practice as many problems as you can and really zero in on defined benefit plans and foundations and endowments. So let's begin. Again, no excuses. This is pretty much on every exam, at least every exam that I remember seeing. And I want you to pass this exam, so we need to focus on this. So university endowments, let's talk about their main features. What is their mission? What exactly are they hoping to do? So a university endowment is a fund that's set up by gifts and donations. So alumni, this is really important in building those alumni networks. These endowments also can be huge. So these funds, what do? They're invested to earn returns that provide support to the university's operating budget. They don't frequently pay the whole university operating budget, but some endowments have bigger percentages that help the university's operating budget. Okay, so what is the main objective? Is going to be to balance the needs of the university today against its needs in the future. So again, I want to point out intergenerational equity. You've got to properly balance the needs for money today with the needs that you may have in 20 or 30 years. Because again, these are long-term time horizons. We cannot pay everything this year and not have no money left over in the future. Okay, and we talked about how some of these endowments can be pretty big. Well, Harvard's ranks right up there with assets under management over 30 billion, and that was in 2016. So these are big funds, and again, they're going to help the university's operating budget. They're going to offer support, but they're not going to pay everything for that operating budget. Okay, so who are the stakeholders? Well, I would say the first one that jumps out at me, the most obvious, the students. The students are going to be the stakeholders, and not just the current students today, but the future students. They're going to want those scholarships and those same opportunities. Alumni who contribute gifts and donations, absolutely they're a stakeholder, and many of these alumni can be very vocal. So you want to make sure that you do a good job here. University employees, well, they're certainly a stakeholder. If the university fails, well, these people are out of a job. And professors, absolutely, they want the university to survive. So stakeholders often have representation on the endowment's board of investors and the investment committee, so they're active. They're involved. This is a team effort. Okay, what are their liabilities and their time horizon? So again, this word intergenerational equity, it comes up fairly frequently in the CFA Institute readings, so make sure that term doesn't throw you off. It just says, because this has an unlimited life of the university, it has perpetual investment horizon, we need to balance the needs of the university that they have today versus 50 years from now. So again, there's a balance that we have to deal with. Okay, so the endowment's liabilities are the future payments promised to the university, and they're often presented in an official spending policy. Okay, this spending policy, again, what should it ensure? Intergenerational equity. Hey, if you're thinking of getting a financial tattoo, intergenerational equity, haven't seen that one before in anyone, so that might be one you might want to consider. And the other thing I want you to think about, there's going to be some smoothing mechanism that's going to insulate the university from market volatility. I don't want to receive, let's say, $2 million one year and then $10,000 the next year. So we're going to have some type of smoothing mechanism that's going to be brought up in this material. Okay, the other thing I want you to think about is that this spending policy. So there's going to be some amount of spending each year, and we can set it up in a nice formula that you have here. What I would like you to do, this is a formula that I would like you to memorize. This is one that I would put on note cards, and this is one that I would understand. So what does all this say? It basically says in English that the amount that we're going to spend each year to support this university is going to be a weighted average of the previous year's spending adjusted for inflation, and there's going to be some spending rate somewhere between 4 and 6% applied to some moving average of assets under management. Because again, assets under management can go up or down, and the whole point is we want to try to shield this up and down movement of assets for volatility that goes to support the university. We want some stable number there. Okay, so this is a key formula, and I'd like you to memorize it. And I want to point out here, notice the W. This is the weight of the previous year's spending amount. And as you can see, it's very prevalent in the formula. So again, all we're trying to do is come up and understand the spending policy at the university. Okay, so there's 3 different types of spending policies, and it really comes down to what we talked about, that W, that weight of the previous year's spending amount. So the first method is just the constant growth rule. We're going to say W equals 1. So the endowment is going to provide a real annual payment to the university once adjusted for inflation. Now, I want you guys to stop for a second and underline this. The Higher Education Price Index, the HEPI. Notice I didn't say the CPI. Frequently questions will give you the CPI, but the CPI might not be appropriate. Oftentimes it's not appropriate. You need to use the inflation rate that's geared towards that endowment. So we're going to look towards the Higher Education Price Index to help us gauge inflation, not the CPI. So again, key point there. Okay, so what happens when the constant growth rule, or W, is 1? So it provides more certainty that the university is going to get some payout. The problem is, what is that payment going to be? And it's going to fluctuate with this model of spending policy. Okay, so more issues if W is 1 on this constant growth rule. In order to deal with this volatility, to smooth it out a little bit, it's often going to contain caps and floors recommending or representing minimum and maximum percentage values of asset over management. And it'll be broken out over 1 to 3 years. So again, what's this going to do? It's going to lower the volatility that the university is going to receive payouts. Again, they don't want to receive all these fluctuating payments every year. It's very hard to run a business or a university if you're not sure where the money's coming and how much you're going to get. Okay, another rule that we can use, how about this market value rule, where instead of saying W is 1, a constant growth rule, let's say W is 0. So they're going to be a pre-specified percentage, so it's usually going to be somewhere between 4 and 6% of the 3 to 5 year moving average of asset values. Not of last year, but of a moving average. Again, we're trying to hold back volatility. We don't want the university to get all sorts of payments every year. Okay, and then there's also a hybrid rule, which is some weighted average of the previous rules. Any information that you need to do this, they're going to give it to you in the exam, but I just want you to have a basic understanding of what happens if this W, or weight of the previous year spending amount, what if it's 0? What if it's 1? What if it's some combination? Don't be surprised if you get a question on that. Okay, the spending policy, diving into a little bit more, how about liability-related factors that we need to consider? I think a big one is, let's talk about your fundraising from donors. Gifts and donors coming into the endowment basically take that 4 to 6 spending rule and maybe lower it to 2 to 4%. So if you have a stable fundraising and gifting from your alumni, that is going to help you. That's also going to mean there's lower liquidity that you need to take out of the portfolio. Okay, let's dive into this. Another issue. What if the university really needs your funds? They really need that to support an existence, or it's very difficult for them. So if the endowment spending is a larger percentage of the university's operating budget, then the risk tolerance is likely to be lower. So their ability to bear risk for these funds is going to be lower because the university needs the money so badly. If they don't need the money so badly, then the ability to bear risk is high because that operating budget is not that important and needs to be supported by that endowment. Okay, the other thing that I want you to focus on, what is the opportunity for this endowment or university to issue debt? So if I have access to the debt markets, that means I can raise money if I need it. So what does that mean? That means my ability to bear risk is going to go up because I can borrow to meet spending needs if my investment portfolio doesn't work. Okay, or at least the endowment that's supporting my university doesn't work. So let's dive now into liquidity needs. So we talked about the annual endowment spending net of gifts is going to be very low. Usually 2 to 4% of the assets. It could be lower if you have an even stronger donor network. So what does this translate into you as a portfolio manager? What do you need to know? So we know we have liquidity needs are low and time horizon is high. What does that mean? That means your ability to bear risk is high. So that means you can pick investments that have a lot of volatility, and you can actually have a high risk tolerance and you can absorb this high volatility. So this is why we see a lot of university endowments with large stakes in alternative investments. They have low liquidity and a long time horizon. It's a perfect opportunity to basically try to achieve and maximize returns. Okay, external constraints. Well, guess what? There's legal and regulatory constraints, and regulation is going to vary by jurisdiction. There's a couple generalities that we want to share with you, though. Endowments are typically subject to laws that do what? Well, they want you to use modern portfolio theory. So we want to look at returns and portfolio on a total return basis, and we want you to diversify. Okay, so that's a frequent rule, is they're going to be based on modern portfolio theory. you're also going to see investment committees and boards, and they're going to have a fiduciary duty or care in overseeing these investments. So this is a very sophisticated corporate governance or governance structure. Okay, so what is the investment objective? Just as we've been talking about in institutions, it's important to understand what is their goal. What are they trying to do? Well, they've got a really simple one within university endowments. Preserve the purchasing power of the assets forever. So what does that mean in English? Hey, grow in line with inflation while achieving returns adequate to maintain this level of spending, which is very low, which is typically 2 to 4%. Okay, so what's a typical spending target? 5% seems to be pretty common. So a typical spending rate target is 5% of average assets. So this, let's translate this a little bit. This means your objective is to generate a real return after inflation, not using the CPI, but the higher education price index, the HEPI, of about 5% on average over a 3 to 5 year period. Okay, so now we're clear what the objective is. We're also going to put some limit on volatility, a typical reasonable volatility limit, somewhere 10% to 15%. I've seen them all sorts of numbers, but that seems to be a good number. I agree with that. Now, there might be a secondary objective. How about outperforming a passive benchmark? Or how about outperform a peer of other endowments? Again, there can be multiple objectives, but again, the primary is what you're going to focus on. If you can do the secondary and the tertiary, that's great too. So given the endowments need to beat inflation, what happens? They tend to have a significant allocation to real assets. Why real assets? Because they tend to return greater than inflation. Because again, that's the goal here. We want to outperform inflation. Okay, we want this to grow into perpetuity and not die in 20 years. So one lesson that we learned from 2007 to 2009 in the financial crisis, we learned a lot of lessons. But this idea of liquidity risk, this seemed to become very evident for university endowments. So what we're going to say, portfolios should be managed with detailed cash flow modeling. And this is where we can incorporate our friend Monte Carlo simulation, again, that the CFA Institute loves. Okay, so some endowments are also going to use liquidity risk bands, and they're going to have an upper bound for an exposure to illiquid investments, and they're also going to factor in any commitments basically to alternative asset funds. So bottom line is we're going to have to start thinking about liquidity. Absolutely, the financial crisis of 2007 to 2009 brought that to the forefront. Okay, what about asset allocation? This is what, as portfolio managers, this is where we earn our living. So most large U.S. investments follow the endowment model, which says you're going to have greater than 50% allocation to alternative investments. Now I have greater than or equal, so we can generally cross that out. It's generally going to be greater than 50%. And what have we seen the last 20 to 30 years? This percentage has only increased. Now I want to point out smaller university endowments, they can't handle these higher allocation to alternative investments. They generally don't have the staff or the resources, or it's just too expensive, or maybe they don't have any expertise. So what do we see here? Well, they tend to have a lot of equities, domestic, I have to point out, and fixed income. And they tend to have this home bias causing U.S. equities to be overweighted. Okay, so we still see behavioral finance comes up. There seems to be a home bias, and these smaller universities have larger U.S. equity holdings. So they may not have a lot of global funds out there or global investments. Okay, so let's talk about private foundations. Now, again, I mentioned university endowments, absolutely critical on the exam, heavily tested. Guess what? Private foundations are heavily tested on the exam as well. And the material now is kind of breaking apart endowments and foundations. They're separating a little bit. I know that they're different. For many years, the CFA treated them exactly the same. Now they're branching it out a little bit more, but at the end of the day, they have very similar characteristics. And we're just going to go into private foundations at a little bit more granular level so you understand there's some slight nuances in the CFA literature it's important to talk about. So what is a foundation? It's a nonprofit institution. It's set up to make grants to support some charitable cause. So the focus of this reading, though, is on private foundations set up by individual donors. So when you think, and you're trying to put this in context, I'd like you to think about the Bill and Melinda Gates Foundation. That's a great idea to really envision where the CFA Institute is going with this private foundation. So what are some main features or missions of foundations? Well, we have community foundations. They're set up for the good of the local community. What is the good of the local community? Seems kind of vague to me, and maybe people would disagree, so it's not so clear. Operating foundations. Hey, I want you to basically set up funds for some not-for-profit business. And then we have corporate foundations that want to set up basically to do something with these profits that's good for society or a community. Okay, the main objective of a private foundation, this is important. You've got to maintain purchase power into perpetuity. It sounds very similar to the university endowment, doesn't it? So you're going to earn returns sufficient to support the activity of that foundation. Who are the stakeholders? Well, it could be the family that funds the money. It could be donors. It could be recipients of that foundation and the wider community, especially if this foundation was geared to improve the benefit of the community. Now, this comes up very frequently when we're dealing with institutional, especially endowments and foundations, these intergenerational tensions. So you've got needs of current recipients. We have to balance that with the needs of future recipients. So again, we can't overweight one or the other. The goal of this is to live forever and to grant this service or foundation or profit, whatever good it's doing, continue it for a long time. So this intergenerational tension absolutely exists. So stakeholders, who else is a stakeholder? The government. Maybe they give favorable tax treatments in this agent area. And one area we talked about a few times so far, this idea of environmental, social, governance investing topics is becoming more and more prevalent in the practitioner world and on the CFA exam. All three levels now are incorporating environmental, social, governance questions. So this term of impact investing, I want you to be familiar with it. So let's talk about what it actually is. So impact investing, maybe you want to increase literacy in your community, or maybe the goal or the mission is to increase women in finance or women in science or disadvantaged children in math. You know, whatever it is, it's basically being used now by foundations that are going into projects that promote that mission or that goal. Now, as portfolio managers, this is very challenging for us because, yes, I want to do those things too, but I have to earn a sufficient return on these assets or we're not going to be around in 20 years. So this is a very difficult area. There's a lot of academic research. I'm actually working on some academic research in this idea of environmental social governance investing and sustainability. So just know that this is a challenge and recognize it as so. So if one of the weaknesses of impact investing is it may not earn a sufficient return. So then you're going to have to get those funds from that money or that return somewhere else. Okay, so let's look at liabilities and now the time horizon. So they typically have a perpetual investment horizon. Now what we are seeing, there is a trend toward limited life foundations. So they're required to spend down their assets within some time period, and it's typically the founder's death. So what did that do? Now the time horizon just went smaller. That ability to bear risk just went down. Okay? Now let's dive into just a little bit more nuances on private foundations. So U.S. foundations, and we're not talking about other countries, just the U.S., they are legally required to spend 5% of their assets plus investment expenses. So unlike universities, which have other sources of revenue outside this endowment, foundations basically exist solely and they're relied upon to meet these budgets. So this, along with the higher liquidity requirements, means that they have a lower risk tolerance than university endowment. So let me repeat that. Private foundations, because they have this higher liquidity requirement, they're going to have a lower risk tolerance than university endowment. Now, it's all relative. It's still long-term, but they tend to have a lower risk tolerance. Now, what do they need in terms of liquidity? They're going to have to maintain sufficient liquidity to meet near-term spending and any capital calls on their alternative investments or any margin calls. So those are some pretty immediate liquidity needs. Now, what about external constraints? So from a legal and regulatory perspective, foundations are subject to similar laws. So again, your job is not to be an expert on laws of foundations and endowments. Okay, but what they do require, and we talked about this, is they're going to want the investments managed on a total return basis, most likely. They're going to emphasize diversification, and there's going to be some fiduciary duty of care, and there's going to be some governance structure that has boards and investment staff. That's about as deep as I'd feel comfortable if you get into these external constraints. Your job, you're not a legal or regulatory expert. So understand that if there's any of this stuff that matters, it'll be given to you in the exam. But your job also is you have to meet whatever these requirements are. So that's something to take note of as you're answering these questions as well. Okay, what about investment objectives? So we want to, in a private foundation, we want to generate a real return over CPI. So again, we've now switched. We were no longer talking about the Higher Education Price Index, the HEPI that we used in university endowments. Now we're bringing down CPI in private foundations. So we want to earn inflation. I want that spending rate of 5% plus my investment expenses. So again, so you've got 5% plus whatever inflation plus expenses. Okay, so that's your objective that you're trying to reach in the private foundation. Now, same thing, it's very likely to have volatility targets. So again, a reasonable range, I think 10 to 15% volatility over a 3 to 5 year period is very reasonable, very common. I've got no problems with that. Okay, now again, there may be secondary objectives. Maybe they want you to outperform a policy benchmark. There might even be something with tracking error. There are a lot of objectives that you can have. But the primary that we just talked about a minute ago is basically you're going to have to earn those returns, the 5% plus the CPI plus the investment management expense. That's really the primary objective. Okay, so let's talk about asset allocation. So we said foundations have a lower ability to bear risk than university endowments. Why? Because they have a heavy reliance on the foundation spending, and they have higher liquidity requirements, which means they have a lower time horizon. However, I want you to focus on this. They still have a long-term objective of beating inflation. So the overall risk tolerance, maybe it's not as high as university endowments, but it's still high. So overall, the risk tolerance remains high with the long-term objective of beating inflation. Okay, so larger U.S. foundations give asset allocations of about 50% to alternative investments. So in the university endowments, we saw much higher than 50%. So now we've got about 50% in alternative investments. So they're still invested in alts, just not to the extent that university endowments are. Okay, and again, smaller foundations, they tend to have less alternative investments. They favor stocks and fixed income, and notice domestic stocks. So again, behavioral finance seems to impact everything in finance now. So we see this home bias occurs that we saw in smaller university endowments. We see the same home bias in private foundations.